What's going on, guys? D. Anthony here with Evolution Traders. In this video, we're going to go over some of the 5-minute setups that presented themselves today on the NASDAQ futures. Now, if you guys have been following my videos, you guys know since last week, I've been working on being a little bit more patient off the open. I'm not getting involved in any 20 SMA plays, any pre-market high or low break right off the open, okay? This market, at least for now, conditions can change, market environment can change, price action can change. We could be having a different conversation where those plays right off the open are working. But for me personally, with the size that I'm playing or feel comfortable playing most of the time, it hasn't been too beneficial. So I've been really trying to stay patient at least 15 minutes, okay? That's bare minimum. I'm getting a little bit more closer into the sweet spot of around 30 minutes off the open, just because I want to see some structure. So if you notice right here off the open, that first 5-minute candle not only confirms the pre-market, little previous price high here that we had, and sets up a 20 SMA play, confirms it, and immediately gets shot down. Okay, so in this particular situation, if you are a trader who is looking for those breakouts off the open or those breakdowns off the open, be careful and be cautious. They do not have to work. Again, with any strategy, with any setup, it does not have to work. And the closer you are to this opening print, the bigger the chance the fake out's going to be. Now, if you kind of get into it, well, the second 20 SMA play that set up for 30 points not only confirms, but it does hit. So, it's like comparing, it's like comparing apples to apples, right? Tomato, potato, potato. Just because you sit out the first 5 minutes doesn't mean that 10 minutes it's going to work. Doesn't mean that, this one doesn't fake you out as well. But again, for the sake of this video, and if we're going to do proper back testing, we've got to go through each and every single trade. Now, it's not until later in the day when you can be a little bit more picky, when the market kind of chooses a side, but especially off the open, if you're going to take these plays, well, you can't just take the long, but then ignore the short, or vice versa. So the play that I really like here was 30 minutes off the bell. And, as you guys kind of know already, especially those of you guys who are trading with me in Discord, I've been sitting out, right? I've been sitting out the first 5, 10, 15, 20 minutes of the day. And I'm waiting for that, hour range candle to get put in. This black box here is the first hour of trading, that initial balance. So I'm also waiting to see if this gets confirmed, whether to the high side or to the downside, or is it trending inside the middle of the range? Now, this 20 SMA sets up here was a 29-point range. I don't need to do the math for you. You can see that it hits at an easy 1-to-1, okay? So this was a 29-point winner. Now, here's where things get a little dicey, okay? Because this 20 SMA play was a 41-point range candle. It does confirm, and right after it confirms, it immediately just goes the other way. How can we avoid taking this loss? How can we avoid taking this loss on this short side? How can we avoid taking this loss on the short side? Well, we can use that first hour range of trading, and we can tell ourselves that if we have not taken out the initial balance low, aka the first hour trading range, if we haven't taken that out to the downside, we need to be a lot more cautious and maybe ignore those short setups. Because in situations like this, what it turns into is a lot of traders try to short the top and pick that next big move. You're trying to short the reversal. You're trying to catch the start of a pullback. And when you do that on a trending day like today, you tend to continuously get chopped up. Now, not every day it's gonna happen, right? You might take this short trade and it might flush 50 points for you. However, when you're trading at the top of the range of the first hour of that initial balance, you want to be cautious of going against what is setting up to be the day's trend. Now, obviously, at this point in time, we have no idea that the market was going to continue to run, right? All of this is irrelevant because we have no idea that this price action is going to print. So at this point in time, all it looks like is a flush, we break out, we consolidate, we put in a lower high, and here it is time to go all the way back down, right? That's what a lot of traders are thinking. We're going to come all the way back down, if not take out the lows, but we're going to come all the way back down, one or the other. However, we can't even really start to think about the short side until we take out the first hour lows. We can't think about the short side until we take out pre-market lows. We can't think about the short side until we start getting below, right? And I'm going to scroll over some of these overnight session lows, right? So if we're pulling back into support from overnight session, right? Overnight session, and we haven't taken out the day's low, first hour range of trading, and we haven't really closed below any of this pre-market action here, right? Leading into the bell, how can we think that the market's going to roll over? Because what tends to happen is traders start to think they know what the market's going to do, or they think something's going to happen. What you have to do is just, if you are going to be aggressive and take that short position, will take your medicine and get stopped out and look for the next long. And until we take out a prior swing low, continue with the long trend. Realistically, you could have entered into the second 20 SMA play off the open at 7 a.m. Pacific Standard Time, set your stop loss, got in at a price of around 19,055, and watched this trade to highs of 19,250. Over 200 points, right? Over 200 points, you could have literally sat in the same trade. Now, again, I'm human. I understand that it's a lot easier said than done. Sure, of course, now that we're looking back at the price action, it's easy to say that we should have held the position all day. No, it's easy to say that based on this entry and based on a reason why candles stop, that as long as we're trading over our stop, we should hold the position. We never got stopped out. And even if once this trade started to move in your favor, we brought this stop loss up to break even, it would have never stopped you out at break even. So essentially, even off the first push higher, you could have elevated this stop loss to break even, went almost to that break even price, and then watched it go up once more. So that's how you can avoid getting chopped up. That's how you can start to stay in the same trade longer. That's how you can learn to train yourself to hold these runners longer, and how essentially you can put on risk-free trades. Again, learning how to do this is very, very difficult, okay? Myself, I'm not a perfect trader. Did I get in on this trade? 100%. Did I make some money on it? Sure. Did I hold it all day? Absolutely not, right? Did I take, the breakout once we broke through and put in this swing high here? Did I take another long here for a little bit of a scalp? Yes. Did I hold it all the way to the end of the day? No, right? So again, you need to identify what is your trader DNA, okay? Are you a type of person that's maybe coming over from swing trading where you have no problem sitting in drawdown and holding long periods of trades? Then maybe something like this might be good for you. If you're a little bit more impatient and you're a scalper and you're looking for those quick moves, then sure, when you get your 10, 15, 20, 30 points here, take your money, be happy, call it a day, right? That doesn't mean take a winning trade here or come late to the market, try to take the short, take a loser, try to take a long, get stopped out, try to go back short. Once you start trying to cherry pick your trades and trying to go back and forth is when traders tend to get in a lot of trouble. Guys, here's just a rule of thumb. If you take that first hour range of trading, and if the price is holding the upper range and it's holding outside of that hour range of trading, 8 times out of 10, you're going to get a trending day, meaning that you're looking to buy the pullbacks for the bounces and not looking to start the short trade for the reversal. Makes sense? It would be the same way if we're outside the first hour of trading to the downside. You're looking to short the bounces and not bounce the potential reversals. I hope that makes sense. Hope you guys all have a fantastic rest of the trading week. Remember, big week this week. We got FOMC, we got CPI, we got PPI. Market should move. All-time highs here on the NASDAQ. What do we do? Yet to be determined. But again, it should be a very, very interesting back half of the week. And we'll see all of you guys on the inside.